This week, the Fed released minutes that showed officials remain far more worried about inflation than employment, especially in the face of renewed tariffs. Yet markets are still betting on a rate cut in September. Meanwhile, gold has held steady. Oil is gaining on strong summer demand, and major mining results like BHP's point to softening global growth. Well, to make sense of it all, I'm joined by Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, thanks very much indeed for talking to us.
Hello, Devan. Thanks for having me back.
Well, look, the Fed's minutes this week show that they are still prioritizing inflation control. I mean, Mike, and as we look at the markets, yet investors are clearly still expecting a cut, right? With oil climbing and gold barely moving, how do you sum up the market mood right now? Is it confidence or confusion?
Well, that's a good way to describe it. I think it's all the above. Remember, this is August. It's summer doldrums max. And I wanted to show you one simple chart as we speak. The average price for the VIX this year so far is 20. It's below that level. It's running 16 as we speak on Thursday the 21st, and it's going to bounce up above. There's a question when. And the average price for Bitcoin, the world's most speculative digital asset, is 100,000, and it's above that level. It's probably going to dip down to those levels. So for now, it's summer doldrums. It's peak. We have to see what Chairman Powell says on Friday, which is by the time we print this, and not much is expected. The problem is we're running into a situation now where there is so much demand for the Federal Reserve to cut rates that it's almost unprecedented. And because they've been cutting rates, yet bond yields have been going up, stock market's been going up, risk assets been going up, and inflation's been running higher than their expectations. And I guess I'm kind of old school. It's just a silly environment that inflation's higher. There's massive speculative excesses in risk assets, i.e. cryptos and Bitcoin. Stock market's on a tear. And the unemployment rate's steady. You don't raise rates in that environment. That's just silly. So I think that's what is happening now. And that's where I think things like gold are figuring it out. And we'll go to that in a second. Gold looks like it's building a nice bull flag. In the meantime, the problem is copper might be building a bear flag.
Let's talk about gold there for a second, right? I mean, it's been holding narrow range, even as oil prices rise on stronger demand. Does gold's lack of movement, so seemingly, suggest it's losing some of its safe haven shine, or is it simply waiting for a trigger, like you said, like Jackson Hole?
Well, I want to show you one chart as we speak. What's happening in gold is, I think the answer to that is no. I think it's a consolidating bull market. In technical analysis, we call that a bull flag. But I wanted to point out one thing that's really happening in gold is significant inflows in gold ETFs. Gold ETFs, total holdings of gold ETFs in terms of the data we have in the Bloomberg terminal are running around 92 million ounces. That's up 11% this year, Devan. That's after 4 years of outflows. And at the same time, that's very rare for that to happen. So you see on this chart, gold ETFs are just taking off. They just broke above a key resistance level that was first breached in 2020 and the way up, and then was kind of a support level in 2023. But at the same time, volatility in the stock market is going down. To me, that's so important. The VIX volatility index, which I mentioned earlier, the 50-day moving average is running 16%. It's heading lower. That hardly ever happens. Usually you have inflows into gold ETFs when volatility is going up and people are starting to get worried about the stock market. So what I think is happening is what I showed you on this first chart here. Is the gold is building a bull flag and anticipating a breakout. It's a matter of time. And yes, it could have issues. It could get down to first support's around 3,300. It could get down to 3,000 support, but it looks like it's ready to break out higher and it's waiting for a catalyst. At the same time, gold's a ancient store value, that it's a rock. You don't want the stock market to be out underperforming the rock, and it is this year. And then there's that most significant economically sensitive metal on the planet, and that's copper. Copper is broken down and hard, and it's just hovering right at a key level. So I see like a bull flag developing in gold and a bear flag developing in copper. And the key things I'm really worried, that signal is showing economic distress on a global basis, which completely makes sense. There's very good reason for it. The most significant tariffs, unprecedented tariffs from the largest goods importer on the planet, last 50 years, is just starting to hit the world order.
Yeah. Listen, so some interesting company results, but I want to, you spoke about economic stress, and one thing I look for is these companies that reflect that, right? BHP just posted its annual profit, lowest annual profit in 5 years, mainly on falling iron ore prices and weak Chinese demand. Now, Mike, does that signal a deeper slowdown in the global economy? And what does it tell us about where base metals might be headed?
Exactly. It's your question spot on, and that's a key thing I'm pointed out here. It's hard to see. Tell you what I'm just telling. This is a ratio of gold divided by copper. So when you say iron ore, I put copper in that same bucket. It's kind of the more actively traded global economic indicator metal, and iron ore declining at the same time government bond yields in China are declining is not a good sign. It's what you would expect from a country that expanded way too fast is now deflating, just like Japan did 30 years ago. And it's clearly the case. And one way I can really tell that is I just take the price of gold divided by copper over time. It's the highest price ever. And that's not a good sign. It's usually a sign of economic stress, which was I showing you on the charts. And that's what I see from what you pointed out is declining profits in miners. And you're seeing that somewhat in declining latest Walmart is having problems with profits. It's the signs, I think, of a global economy tilting towards recession, unfortunately. And you really see that in this charts. And to see the highest ever gold versus copper, sure, that's a recessionary environment. And what I show you in the magenta line is when you had that big spike in 2008, that was a recession. The thing is now it's front running. But one thing that's really notable is what I'm really concerned about is the key thing that got me bearish in 2008 is how low volatility in the U.S. and how very high rates are in the U.S. So that ratio, that's just 24 months, is bottoming. Volatility, stock market volatility minus the T-bill rate is bottoming from the lowest level since 2007. So to me, this is what's happening. And it's showing up in things like you pointed out. So one thing I'll end with and point out, I think that's highly significant is what the data that's happening in China. So we mentioned bond yields are like 1.75% or so versus the US at 4.3%. That's a 10-year note. But that's happening with PPI in China running minus 3.6%, yet PPI in this country is running way above CPI, which is not a good sign for corporate profits. And at the same time, you're seeing massive stimulus in China as measured by money supply in China is $45 trillion. That was double the money supply in the U.S. So there's massive stimulus. And despite that, you're seeing deflation in the world's second largest economy, which is now exporting their deflation around the whole world, notably because the U.S. is cutting them off. You see a trend there? And that's what I show in this chart. This chart, to me, I think is front running. You see that all in commodities and metals. And part of that is crude oil going down, the grains going down, and the only major commodity really seems to be sustaining its uptrend is gold.
Yep, now that's interesting indeed. So listen, we've got Jackson Hole over the weekend. I mean, beyond that, what are your eyes on as we get into next week?
The key thing I'm watching to see from an economic standpoint, I'm seeing if copper breaks down, and I put that in the same category as Bitcoin. And that's why I wanted to show this chart here. This is what I'm watching. And just I'm worried about a little mean reversion. And this is, first put it away, this is going to happen. The VIX will go back to 20. It's the question, does it stay above that level? And I think the risk is it will. Why do I say 20? It's the average this year, and the last average for the last 2 years was below 14 or 15. At the same time, the world's most leading economic, risk-on indicator, Bitcoin's broken out to new highs. I think it's going to go back to 100,000. And the question is, does it bounce or go back higher? The risk is towards the end of the year, we go, we break VIX resistance and we break Bitcoin support. So I'm just looking for normalization. I'm just looking for a little bit of volatility. The problem is I think everybody is, and they're probably somewhat set up for it.
Yeah, that's going to be very interesting to watch. Well, listen, always a pleasure. Thanks very much indeed. Mike McGlone is the Senior Commodity Strategist at Bloomberg Intelligence. Mike, thanks for your time once again.
Thank you, Devan. It's a pleasure to be on.